Welcome to our financial education webinar. I'm Jacqueline Ozdemir, joining you from Ferguson Financial Planning at Asante Capital Management, and I will be taking you through today's presentation. Our webinar today is expected to last about 1 hour, and I am recording it. So if you need to jump off, no problem. I'll make sure you get a link to our YouTube channel afterwards so you can watch the recording at a later time. Because I am recording the session, I have turned off everyone's microphones and cameras. So if you need to ask a question, you can do so by either scrolling your mouse above the top or bottom of your screen, and you should have the option to ask a question through the chat or through the Q&A. Definitely, as always, I'll try my best to answer it throughout the presentation, but if I don't get a chance, then I can send you an email afterwards as a follow-up. Okay, so like I mentioned, we're going to be doing a webinar on financial education today. We have a ton of topics to cover, but before we jump in, for anyone who's maybe not familiar with the team or wasn't really sure what to expect coming into the session today, I did want to address a few things right up front. So coming into the session today, I figured some of you might have a few questions. I thought some of these questions might be things like, who is Jacqueline Ozdemir, and what does Ferguson Financial Planning do? What is the purpose of today's webinar going to be? And finally, specifically, what are we going to be talking about? So to answer some of those questions, first of all, I am Jacqueline Ozdemir, and I'm with Ferguson Financial Planning, and I'm a financial advisor on the team. We help our clients with all aspects of wealth management. So when you think of wealth management, you ask anyone for a definition of wealth management, you're probably going to get a ton of different answers. On our team, we do have a very comprehensive view of what wealth management is. And so to us, it means investment consulting. So that is going to be helping our clients set up the right types of portfolios for them based on their risk and return objectives. Beyond that, though, we also help our clients with wealth enhancement. So what I mean by wealth enhancement is how do we help our clients enhance their wealth through mitigating taxes legally? Okay, so we're going to come up with strategies like that for them. We also help our clients with wealth protection. So how can we protect our clients' assets and wealth from deterioration in the event of death, disability, or illness? We also help our clients with wealth transfers. So, once you've built up your wealth, how can you make sure that it is transferred to the next generation, to your beneficiaries, to your loved ones, to a charitable cause? We help our clients make sure that that all happens efficiently and with minimal taxes as well. And finally, we can help our clients maximize the impacts of their charitable gifts to the extent that they would like to be charitable. Now, we are not an expert in all of these things, but we can certainly identify our clients' needs for this type of planning. And for that, we will work with a team of accountants and lawyers as well with you to help in some of these areas where necessary. So the purpose of today's session, though, is to really educate you on a lot of all of those different topics. Now, for those of you who have been joining our webinars throughout the year, you'll know that we've covered quite a lot of topics already this year. And so the purpose of today as well is to act as a refresher on some of those topics. And for those of you who haven't attended those webinars, this is really meant to be kind of like a speed course to get you up to date and up to speed with a bunch of different aspects of personal finances, okay? Specifically though, the topics that we're gonna look at today are going to include an overview of financial accounts, okay? So we're gonna talk about what is financial accounts. This is gonna be fairly basic, but it's gonna set the stage for a lot of the rest of what we're gonna talk about today. We're going to drill down a little bit more on registered education savings plans. Again, I did do a full session on this a couple months ago, so I'll make sure that everyone gets the link to that as well in case they want to know a little bit more. So we are going to be talking about RESPs, who they're for and some best strategies for them. We're also going to be looking at registered retirement savings plans and tax-free savings accounts, specifically, what they are, and again, some strategies or best practices for using them. We're going to be looking as well at retirement income. So, what types of income could you expect to be receiving in your retirement years or sort of beyond the age of 60, 65? And then finally, we're going to wrap up by talking about insurance and ways to protect your wealth and to protect your income, and also about estate planning to make sure that those wealth transfers to your beneficiaries are done as efficiently and tax efficiently as possible. Okay, so to jump things off, let's start talking a little bit about financial accounts. So for us at Asante, financial accounts really means investment accounts. Okay, so we're not talking about, you know, your checking or savings account at the bank. We're talking about accounts that you can invest in. So if you think of an account, you can almost think of it like a bucket. And it's a bucket that you can put money into and you can buy certain things. And the idea is that those things grow over time and you get more money. Okay, so that's kind of basic investing 101. The types of investing that we'll do for our clients are going to be things like buying stocks or buying ETFs and mutual funds, which are really collections of things like stocks and bonds. We also do a little bit of GICs. So those are low or no risk investments with a guaranteed rate of return, although albeit quite low given current interest rate environment. But generally speaking, we're helping our clients build diversified portfolios based on different goals with different target asset allocations, different risk preferences. More recently, we've also been seeing a lot more ESG investing. Okay, again, I did a whole session on this back in the spring, but ESG investing is going to be investing in companies that are either, you know, good for the environment and for mankind, or they've adjusted their business practices or their manufacturing in a way to try to reduce climate change or reduce their carbon footprint. Okay, so we could talk about this all day, but again, it's just a type of investing that we do incorporate into our clients' portfolios. Okay, so now that we know about the different things that we can invest in, how do we invest in these things, and what type of accounts are generally available to most Canadian investors? The first one that I'm going to mention is a registered education savings plan, or an RESP. This is really only going to be relevant if you're saving up for a child's post-secondary education. Okay, so that's when you'd be looking at opening up an RESP account. Most of you are probably familiar with tax-free savings accounts, or TFSAs. This type of investment account really can serve any purpose for you. You can put money aside to save for retirement. You might be putting money aside to fund certain lifestyle expenses, or you might be putting money aside in this account for a big purchase like a house one day. Okay, so the sky's kind of the limit when it comes to what you can use your TFSA for. The next type of account that a lot of people will be familiar with is an RRSP. Okay, so a registered retirement savings plan. This type of account is generally used to save for retirement. Okay, there is one exception, and that is the first-time home buyers plan. I'll talk about that a little bit more in a little bit, but that is, you know, these are sort of the two primary reasons why someone is opening and contributing to an RRSP account. Some of you might be familiar with what's called a LIRA, or a locked-in retirement account. This isn't really going to apply to everybody, but what this is basically if you've worked at a company where a pension was offered and you had a pension and you've since left that company, you have the option to take your pension with you. So either you will usually, when you leave a company, either have the option to leave your pension there, and your company and the pension board company that they've chosen to run it will sort of manage it on your behalf, or you can take it with you to somewhere like Asante and have a little bit more control over how those funds are invested, okay? But again, that money is going to be treated similarly to an RRSP and is really meant to fund retirement. Registered disability savings plan. We're not going to spend too much time talking about this today, but this is the type of account that would be anyone who qualifies for the disability tax credit would be eligible to open up an RDSP. An RDSP really has some great savings opportunities. So whether you're investing it in for yourself or on someone else's behalf, it does attract quite a lot of government grants and extra incentives. So definitely might be worth checking out if you think you or someone you know qualifies for this type of account. Finally, the last type of account that's available to most Canadians is going to be a non-registered account, okay? So all the accounts prior to this, all of them have some sort of special tax treatment. There's some beneficial tax strategies you could do with them. A non-registered account offers you no tax protection and is going to be fully exposed to taxes, but is really your best bet if you've kind of exhausted all the other tax sheltered accounts that are available. Okay, so we're not going to spend too much time talking about that, but those are, generally the types of accounts, investment accounts that are going to be available to most Canadians. Okay, so going into our second topic is, RESPs, or registered education savings plans. Again, this is really an investment account. and it's used to fund a beneficiary's post-secondary education and related expenses. So in other words, this is an account that you're setting up for a child. So while you might be the owner, the beneficiary is the child. Okay, so that's a little bit different than a lot of other accounts that we're going to look at today. You're setting it up, you might be contributing to it, but it's for the benefit of somebody else. Okay, and the money that you save in this account can ultimately be used to pay for future tuition for a qualifying post-secondary education school, so a university, college, some trade schools, and also related expenses, so things like textbooks and residence. Okay, most of the time it's going to be a parent or a grandparent that's setting up this account, or another family member, and they are the ones contributing to it. Okay, so a couple really special things about RESPs and what makes it so attractive is that the government will actually match some of your contributions. So if you put money into an RESP, the government will match up to 20% of those contributions. So for example, you put in $1,000, you're going to get $200 from the government to put in that account as well. There is some sort of caveats to that. So over the course of the RESP, or for one child can only attract $7,200 of government grants. So even if you put in way more money, you're only ever going to get $7,200 of government grants. As well, the government will only give you a maximum of $1,000 of grant money per child per year. So for instance, if you put in $2,500 into the account, that will attract a $500 government grant. If you put in $5,000, that will attract a $1,000 government grant. If you put in $6,000, you're still capped at only receiving a $1,000 government grant. And so it's for that reason that sometimes it does make sense to time your contributions a little bit to make sure that you're always maximizing that government grant money that is offered to you. Okay, when you put money into an RESP, you don't get any sort of tax benefit. So unlike the RRSP, where you put money in, you get a nice little tax deduction, CRA does not really care that you put money into an RESP and you're not saving anything on taxes that year. Where you will save though is while the money is actually in the RESP, so it's in that RESP bucket, any investing you do, any buying, selling, any interest that's paid out, you are not going to be paying any taxes on that. Okay, so you're not getting a T-slip for any sort of transactions that occur in the RESP. In the future, when you go to take the money out, it will be taxable, okay, but it's taxed in the hands of the child. So even though you might be the, ultimately the one getting the money and paying for the school, that money that comes out, that growth money, is going to be taxed at the child's tax rate, which, let's be honest, a child that's attending post-secondary education might not be working or might only be working full time. So their tax bracket, their tax rate is going to be relatively low. In addition to that, they're also going to have tuition credits that they can apply on their tax return. So chances are any taxes that are owing on these withdrawals are going to be pretty minimal. Because of this beneficial or sort of some of these tax savings that you get from having an RESP account, there is a maximum amount that you're allowed to put in, and that is $50,000 per child. So even, you can't just open up 10 RESP accounts and put 50,000 into each. No, it's per child, and it's tied to their SIN number. So it's $50,000 per child over the course of sort of the RESP lifespan. So now that we've talked a little bit about what an RESP is, what are some of the best practices or some strategies for setting up an RESP? One thing I always recommend is setting up a family RESP. So a family RESP allows you to have multiple siblings or children in the account. So as opposed to having an RESP account for each child that you have, you could set up one and then sort of put all the children into it, okay? They each still get $50,000 of contribution room available, and you still get the $7,200 of government grant provided that you put in the maximum amount of contributions. Even if you have one child, you can still just have a family RESP account. The benefit of doing it this way is that in the future, say for instance, you have 2 or 3 children and they're all in this family RESP account, by having one account, if one child doesn't pursue post-secondary education, or they do and it's not very costly, another child can use up a lot of their funds, okay? So this way you get to kind of share the money from the account, and this is, really going to help increase the probability that all the money in the account actually does get used if you're able to share it amongst siblings. And again, if you only wind up having one child, you can still have a family RESP. There's no harm to doing that. Another strategy I generally like to recommend is that it's the parent or the primary caregiver that sets up the account. The reason for this is because if you pass away before the RESP has been used, it does create a little bit of estate challenges, estate planning challenges or problems. And so by having a parent versus, let's say, a grandparent set up the account, it does increase the probability that, that owner of the account is going to be alive and well when the funds need to be withdrawn, and just makes it a little bit easier from an estate planning view. Okay. Other things, that we get asked about a lot is, from a client, I've set up this RESP, I've contributed the max amount. I don't know if my kid or kids is going to be attending post-secondary school. What do I do with this money? Like, I put money in, it's grown, I got this government grant, I don't want it to go to a waste. What are my options? So when asked that question, I like to remind people that, let's just wait and see, because you can actually keep an RESP account open for 36 years. So just because your child isn't necessarily attending post-secondary education, at age 18 or 19, doesn't mean they're not going to attend at age 28. So definitely keep it open and see if the money gets used at a future date. In the event that's not happening and no, the kid's actually not going to school, what do? You can transfer it to your RRSP. Under this situation, you're going to have to, of course, pay back the government grant money, because the government grant money was meant to fund post-secondary education, not your retirement. So you're going to have to pay that back, but then you can roll over your original principal and your growth to your RRSP. Just keep in mind, you're going to have the RSP room available. So if you have $50,000 in your RESP, you have to make sure that you have $50,000 of RSP room available. Okay. Another option is that you can also roll over the principal and the growth into a registered disability savings plan. Again, this is going to be another great way to save for beneficiaries for some future purpose and to provide future cash flow to that beneficiary. Okay. And finally, the last option, and probably the most punitive, is to actually close the account. So under this situation, if you are not rolling it into an RSP or an RDSP, you can just take the money out. In this situation, of course, you're going to have to pay back the government grant money. You will also have to, you can take your principal, but any growth money will be taxed at your normal tax rate plus 20%. Okay, so you're going to lose quite a bit to taxes under this scenario. I will say this, in the 6 years that I've sort of been doing this, I've had one situation where we actually had to close out the RESP. And for the rest of my team that's been doing this for longer than I have, I think it was the first time they'd ever seen that. Okay, so it's not something that happens that frequently, but if you're worried about this, it's something we can certainly help you plan for. Okay, so now that we've kind of covered the education savings plan, I want to move on to, oh, sorry, I have a few more things to mention. I forgot. When it comes to RESPs, and this is going to be true for any investment account, when it comes to the investing, consider your time horizons and your risk profile. Okay. So someone who's setting up an RESP today and, their child is 1 and they're not going to be using the funds for like another 17 years, they're probably going to have a much different looking portfolio than someone who has children that are 17 and 18 and that they're starting to draw from the account potentially. Okay. So we can help you set up the right type of investments based on your time horizon, your return objectives, and your risk profile. Okay. Another thing to keep in mind is that I mentioned earlier about maybe having the parents or the primary caregivers set up the account, but that doesn't mean that grandparents or other family members can't contribute to the account. They can put the money in or they can give it to you to put in, but this is a great place to park some cash if you find that you're getting, money from family members for birthdays or other special occasions. But, just be careful and make sure to plan your contributions right. And so that you don't over contribute and lose out on some of those government grants. And again, if you're unsure about that, or you're unsure how much contribution room you have, we can certainly help you figure that out. Okay. So now that we're done with RESPs, I'm going to move on and talk about tax-free savings accounts and registered retirement savings plans a bit. So both of these accounts, again, they are investment accounts. So you think of them like a bucket. You can put money in, invest in different things, and ideally both of these accounts are going to grow. Okay, so to explain what these accounts are and how they work, I like to sort of actually review the similarities and differences because that's going to give you a really good idea about how these accounts operate. So like I mentioned, both a TFSA and an RSP are investment accounts, and they're both tax sheltered. So once the money is in there, again, you're not getting any tax slips on a regular basis, you know, for capital gains from buying and selling or for interest income or for dividends. You're not seeing any of those types of tax slips, okay? For the most part, there is some exceptions, but that's sort of beyond the scope of today's presentation. With an RSP, however, and probably most of you are already familiar with this, is that you do get a nice little tax deduction when you put money into your RSP. So when you contribute to the RSP, in the eyes of CRA, you are effectively reducing your taxable income, and you ultimately are either therefore getting a tax refund or you're owing less taxes if you happen to owe taxes. Okay, so that's how that works. And the amount of the deduction you get is directly related to your income bracket. So the more money you make, the higher your income bracket, and therefore the more savings you get when you contribute to an RRSP. Okay. TFSA, on the other hand, CRA doesn't really care if you put money in. They're not giving you any sort of tax break on that year's tax return that you made the contribution. On the flip side, when you go to take money out of your tax-free savings account, again, CRA does not care and you do not pay taxes. So if you invested, I don't know, $50,000 into your tax-free savings account, it grew to $80,000, you can take out that full $80,000 and you are not getting any taxes. Okay, so that's great. An RRSP, on the other hand, yes, you got to save some taxes when you put money in, but guess what? When you take money out, you're paying taxes then, and you're being taxed as if you were making income. So a lot of times, you know, I'll be working with clients and they'll say, oh, I don't even know why I bothered contributing to an RSP because all I'm doing is paying taxes whenever I take the money out. So these might be clients who are in retirement and they're taking money out and they're saying, well, I'm just paying all these taxes. So I often like to remind them that, well, remember when you contributed to the RRSP, you were probably making more money and you were saving more on taxes than what you're currently paying today. Okay, so it's just kind of how you look at it, and just remember that if you're paying taxes on the way out, it probably means that you saved on taxes when the money went in. Okay, so it generally is still beneficial to contribute to an RSP. Again, there's going to be some situations where it might not be, but for most of it, it's going to be beneficial to contribute to that RSP. Both of these accounts obviously have some great tax savings and some tax advantages. And so obviously as such, we can't just throw all our money into these accounts. There is a limit to how much we're allowed to contribute to each. Okay, and I'll talk a little bit more about that in a moment. One thing I like about both of these accounts, and this is true about most of the accounts we're talking about today, is that you can name a beneficiary. So this means you can actually say on the account, when I pass away, I want so-and-so to get all this money. This is unlike some other types of accounts, like a non-registered account where you can't name a beneficiary, and therefore you have to rely on your will, and your will dictate who gets the money. But you can put someone on your TFSA and your RRSP to say, these people get the money when I pass away. This is going to save a bit of time, and it's going to make sure that the money gets in the hands of the beneficiary a little bit quicker. Okay. Both of these accounts technically can be used to help you fund a first-time home purchase. So a TFSA, like I said, you know, sky's the limit when it comes to what you want to use the money for. Again, you can put money in your TFSA. Just say you start contributing when you're in your 20s, and then in your 30s, you buy a home. You might say, you know, I'm going to take out my savings from my TFSA and use that to buy a home. You can also do this with your RSP. And this is kind of the one time only chance you get to take money out of your RSP without having to pay any taxes. But how it would work is, again, just say you've been contributing to an RSP. I don't know, I'm going to throw, you start contributing in your 20s. And then in your 30s, you say, I'm buying a house now, and it's my first time buying a house. And of course, the CRA website has a whole list of, you know, what qualifies as a first-time home purchase. But you can take money out of your RSP up to $35,000 and put that towards a home purchase. Now, of course, you have to have $35,000 in your account to take out that amount, but otherwise you can take that out. You don't pay any taxes, but you do have to pay the money back over about 15 years. Okay, so just keep that in mind and make sure that you'll be able to fund that cash flow of paying back your RSP over 15 years. When it comes to how long the money can be invested, in a TFSA, you can keep the money in there for as long as you want. So just say again, you start contributing when you're 20, 70 years later, now you're 90, you could have kept the money in there the whole time and never touched it. An RSP is a different story. Because you save taxes when you put money in, the government sort of comes a knocking at a certain point and says, okay, you need to start taking money out. And remember, that money that you're taking out is taxable. So at age 71, you have to convert your RSP into what's called a RIF, or Registered Retirement Income Fund. And then at age 72, or the year you turn age 72, you have to start withdrawing from the account, whether you need the money or not. The amount you have to withdraw is a percentage of your market value of your account. So generally speaking, if you're 72, you're going to have to take out about 5.5% of the value of that account that year. Okay. And again, that money is going to be taxed like income. Okay. So when we think about these accounts, there's a couple other things I want to mention, specifically, who's allowed to contribute to these accounts. TFSA is pretty straightforward. If you're 18 or older, you can contribute. An RSP, on the other hand, you have to be filing a tax return and have earned income. Earned income for most of us is going to be simply our employment income. However, it can also be income from a business that you run, income from a rental property, royalty income. There's a whole list of stuff that qualifies. But again, for most of us, that's going to be our employment income is going to be considered that earned income, and we're going to be filing a tax return. As of 2021, anyone that was at least 18 in the year 2009, when TFSAs were rolled out, could contribute $75,500. So if I'm working with a new client and they were 18 in the year 2009 or older, and they've never opened up a TFSA, I would be telling them, you can contribute $75,500 to your TFSA this year. An RSP, I wouldn't be able to tell someone, oh, you have X amount of room. I would encourage them to show me their notice of assessment, because their notice of assessment from when they filed their tax return is going to show me how much room they have available. Okay, so everyone gets the same amount of TFSA room. RSP room is going to be a product of your income over the years, okay, of how much you can contribute. Each year, we get additional amounts or contribution room that we're allowed to put in. Currently for the TFSA in 2021, an additional $6,000 of room rolled out or opened up. And then again, for 2022, it's going to be the same. It's going to be $6,000. With your RSP, again, it's a bit of a formula, and the amount of contribution room you get each year is going to be a product of your earned income. And there's a formula on that. Okay. Now, in both accounts, you can take money out. With a TFSA, if you take money out in a particular calendar year, you lose that contribution room until the next calendar year it opens up again for you. That's why I really urge people not to use their TFSA like a checking account with money going in and out, because believe me, it's going to be very easy to over contribute unknowingly, and then you're going to get a little fine from CRA that no one, obviously you don't want to pay. With the RSP, again, if you take the money out, you are, losing that contribution room sort of indefinitely. Okay. So now that we know a little bit about RSPs and TFSAs, let's talk about some best practices or things to consider when setting up these types of accounts. So, you can see that each account has different tax treatment. And so it would make sense that based on your tax situation, one account might make more sense over the other. Now, a lot of times I'm going to say, do both. Okay. But in the event that you can't, because obviously cash flow is limited for all of us, what account is going to be best for you in a current year or current situation? Now, again, this is very general, but for a lot of times to be younger investors or those with lower income, I'm generally going to recommend a TFSA if they only want to do one account. Again, because they're in a lower income bracket right now, they're not going to get those huge RSP tax deductions. So that's why TFSA might make more sense. And again, if you need the money in the short term, a TFSA is going to make more sense because you can take the money out with no tax implications. An RSP, on the other hand, might make more sense for someone that's earning a high income, but is expecting to have a lower income in their retirement years. And again, the money is not needed for retirement. That's going to be, a basis for setting up an RSP over a tax-free savings account. I do recommend making contributions early in the year. I mentioned again, all these accounts have tax sheltering available. Of course, the longer the money is actually in the account, the longer you get to take advantage of those tax sheltering opportunities, which is why I say put the money on early in the year. So Also consider planning the timing of your RSP deductions on your tax return where it makes sense to do so. And I'm going to explain this by using an example. So say, for example, I make a large RSP contribution in March of 2022. Then in April, I lose my job and I don't find another job until the end of 2022. My income for 2022 is going to be pretty low because I was not working for over half of the year. So now I go to file my 2022 tax return and my tax bracket is pretty low. So I will tell CRA that I made an RSP contribution, but I'm not going to deduct that contribution from my income in that particular year. I'm going to save it for the next calendar year or another year when my income is higher, my tax bracket's higher, and I'm going to see a bigger, more meaningful deduction on my tax return. Okay, so just because you made an RSP contribution in one year doesn't mean you need to apply it to your tax return for that calendar year. Okay. Another thing to keep in mind is to assign beneficiaries properly. This is not so much an issue for a tax-free savings account because you can, you'll select somebody and then the money will be paid out sort of tax-free to them. With an RSP, on the other hand, if you are married or in a common law relationship and you want your spouse to get that money when you pass away, make sure you assign them as the beneficiary. Okay. Not all of us have spouses or common law partners, but if we're leaving it to a child or we're leaving it to someone else, keep in mind that when we're leaving it to someone other than our spouse or common law partner, the account is liquidated, or it's like it was liquidated the day before we die, and all that money is taxable. Okay, so if you have a large RSP account, let's say 800. Okay, everyone, I just had a quick malfunction there, so I'm not sure if I got cut off. I'm going to continue with the presentation. In the event that it didn't go through or you weren't able to hear me the whole time, I will make sure that I record this and get everyone the link. Okay, so I'm just sort of starting this again, and apologies again, I think I might have got disconnected here. Okay, so we should be up and running once again. I'm just going to check to make sure that everything is working well from a technology standpoint. Again, I apologize for that, everybody. Okay, perfect. So I just got a note it's starting where I left off. Okay, great. So we're back up and running. Sorry about that, guys. Not sure what happened. So we're talking about TFSA and RRSP strategies. I talked about making sure that you're assigning a beneficiary correctly. So if you do have a spouse or common law partner, it might make sense to leave the money to them with your RSP. Otherwise, you're going to see a huge tax bill. Of course, we can't always avoid this if we don't have a spouse. But one thing we can do is we can use insurance to cover that final RSP tax bill that we'll get when we pass away, and more. We'll talk about more about that in a minute. So another thing to keep in mind, and again, this is just a common theme with a lot of our investment accounts, is when you are investing, consider your time horizon and risk profile. Again, it's likely that someone who's starting off investing and has a very long time horizon and is not planning on using these accounts for 30 years is going to have a much different looking portfolio than someone who's currently retired and is drawing on these accounts and relying on these accounts for income every year. Okay. So we've talked about, a lot of personal different savings accounts. And so now I want to switch over to the second half of today's webinar, and that's going to be talking about, what happens in retirement. Okay. So when we're retired, we're going to have different sources of income other than our employment income, because we're no longer working, that are available to us. And there's different types of income that could be, that we could get in retirement. So these are, a combination of our personal savings. And again, we've talked about tax-free savings accounts already, RRSPs, some of you might have LIRAs. So again, these are pension plans that you took over from your company that you've taken control of, or you might have a non-registered account, which is again, another type of investment account. So if you've set up these types of accounts, then you can use them to help fund your retirement. Okay. Some of us might also be eligible for pension plans. So if we worked at, certain private or public companies, sometimes we will be eligible for a pension plan. So this is where, you or you and your employer are contributing to it and while you're working. And really what this is going to do is a pension plan is going to provide you with a regular cash flow when you retire. Okay. Obviously, the longer you work at the company or the more you contribute, the more you're going to be eligible for. We're also going to see some of us are going to be eligible for Canada Pension Plan and Old Age Security. So, these are really sort of the three main sources of retirement income. Now, we've already talked about personal savings and how that works. A pension plan is pretty straightforward. Again, not all of us are going to be eligible for that because not all of us work at a company with a pension plan. So I am going to be talking about more government retirement benefits, which is going to be our Canada Pension Plan and also our Old Age Security. So Canada Pension Plan is exactly that. It's a pension plan available to Canadians, but who is it available to? It's available to those of us who contribute to it. So in order to be eligible to receive CPP, the Canada Pension Plan, after age 60, you have to have contributed to it at some point in time. Generally speaking, so we do contribute to it, and those amounts come off our paychecks. So there's a certain amount that you contribute each year, and it's based on your income. So, and there's a maximum amount that you can contribute each year, and that's going to dictate how much you get when you start collecting it in the future. So how much you get in the future is going to be a product of how much you are contributing it to it during your working years. If you make $64,000 or more as of 2021, you are contributing the full amount to Canada Pension Plan, which is $3,500 a year. Your employer is going to match whatever you contribute, so they'll also be contributing $3,500 a year. If you are self-employed, you don't have an employer matching your contributions, and so you are paying the full $7,000 a year. Now, if you make more than $64,000 a year, you might notice that at some point during the year, your pay seems to increase from your employer. And that's because you're done contributing to CPP for the year, you've maxed out, and so you're no longer contributing, so there's less deductions coming off your paycheck, and so it looks like you're making more money. All good stuff. If you're making less than $6,400, that scenario won't happen, and you are not contributing the full amount to CPP. Now, the amounts I've shown on the screen here represent the amounts that you could be eligible for at any particular age. Most people are going to start collecting their CPP at age 65. Again, this isn't just some magic check that's going to show up in the mail. You do have to apply for it, okay? So you can do that through the Government of Canada website. At age 65, you could start collecting $1,200 a month. Now, this is the maximum amount that someone would be getting in 2021, and this is the amount you would get if you contributed to CPP for about 39 years, and you always contributed the maximum amount each year that you could contribute, okay? So it's unlikely that most people are going to be collecting this money. In fact, as per the CRI website, as of 2021, most people at age 65 were getting about $700 a month from CPP. So significantly less than the maximum of $1,200. Now, some people might say, hey, I want to start taking my CPP a little bit early. Maybe I retired before age 65. I would really like the income, and I'm entitled to receive that money. So you can start collecting it as early as age 60. Now, for every month before our 65th birthday that we elect to start taking CPP, we get a little bit less. And so if you take CPP at age 60 versus age 65, you are entitled to about 7.5% less than you otherwise would have gotten. Okay, so there's certain reasons why people might want to start taking their CPP early. And keep in mind that that $770 continues on. It doesn't jump up to $1,200 at age 65, but that $700 a month plus a little bit of indexing for inflation will just continue on for the rest of your life. Some people are maybe still working at age 65, or they don't need their CPP. So they might say, hey, I'm going to wait until I'm 70 to start collecting it. And if I do that, I'm going to get even more, because you get an extra about 0.7% per month for every year that, or for every month past your 65th birthday that you deferred. Okay, so again, this is a program that you're eligible for if you've contributed to it, and the amount you contribute will dictate how much you get, and the amount you contribute is a product of your income. Okay. The second type of plan, which is a little bit more widespread available, is old age security. So old age security is not something that you contribute to. In order to be eligible for it, you have to be at least 65 and have lived in Canada for a certain period of time. At age 65, you're entitled to about $600 a month. If you wait until age 70, again, you kind of get a little bit more because you've deferred it, and you'd be eligible for about $830 a month. Now, this is meant to be old age security and otherwise providing security, you know, past age 65 or past your years that you might be working. If you make too much money, you don't get this. Okay, so you're thinking, well, I'm retired, how am I making any money? Keep in mind that those personal savings, specifically your RSP, your LIRA, your non-registered account, those are all going to count towards boosting up your income. If you have a pension plan, that's going to count as income. And so it is actually possible, and there's other sources of income as well, like rental income. It is possible to actually be making more than, be making a high income past age 65. And so as it turns out, if you make more than $79,000, the government's going to start clawing back. So it's called clawback, clawing back some of this old age security. They will claw back about 15 cents for every dollar that you make above 79,000 from all those other sources of income. Oh, and I should mention CPP is also counted towards that total. So if you make $130,000 a year, you know, past age 65, or each year that you make over 130,000 past age 65, you will not be eligible for any old age security. Okay, so if you make too much money, you don't get the old age security. So what are some best practices or just some sort of things to consider when you are collecting, you know, various sources of retirement income? You're going to want to consider the timing of when you take the income. So you can start withdrawing from your RSP at age 72. You know, you have to start withdrawing from it at that age, but you can start taking from it earlier. But you're going to want to consider, you know, what is my income bracket at that time? And does it make sense to be taking from my RRSP? And should I also be taking from CPP? And should I also be taking from old age security? And when should I start taking my company pension? So you really want to sit down and think, okay, what's my cash flow going to look like? What are my taxes going to look like? How much do I need? And, you know, from there, we can figure out what is the optimal time to start taking all these different sources of income. As well, if you're going to have a very large, perhaps business transaction one year, or a significantly high income one year, which is kind of an anomaly, again, we might want to choose to defer old age security a little bit just to make sure that you're actually getting it and getting a little bit more. You know, one big question we get is, oh, geez, you know, when do I take CPP and old age security? Because you've told me that I can take CPP between age 60 and age 70. I can choose to start collecting it. And you've also told me I can start taking old age security between age 65 and 70. So what's the best age to do this? Generally speaking, and again, every situation is going to be different, but if you have a, you know, healthy family history and, you know, you're healthy and you think you're going to live a long time, you're probably better off deferring these sources of income. But again, this is going to be unique to everybody, and we can certainly help you figure out what is the optimal age for you. Okay. So this brings us to our final topic, which is about insurance and estate planning. And so you think about it, you're working, or you've worked really hard over the years, you've built up wealth, or you're earning an income, you know, how can you protect that income, or how can you protect that wealth? So there's different types of insurance that's going to help protect that. And I'm not talking about home and auto insurance here. I'm talking about personal insurance. So insurance that's going to help you, or it's going to help your loved ones. And then I'm going to touch a little bit on wills and powers of attorney, which are really the basic estate planning documents that most people should have. Okay. So when we think about insurance, I like to put up this sort of visual here, because life insurance really follows almost like a life cycle. And so when we're younger and we're working and maybe we're building our families or we're building our careers, we really want to protect our income, okay? Because that's what we have. We have our income, that's what we're making. We might not have built up a lot of wealth at this point, but we're starting to build our income, and we might have significant debt as a result of a home purchase or another major purchase. And so there is different types of insurance available to help protect income. The main ones are going to be term insurance, critical illness, and disability insurance. So what term insurance is going to do is it's going to cover you for a set period of time, usually about 10 or 20 years. You set it up and you say, okay, I'm going to take out a term policy for a certain amount, let's say $500,000, and I'm covered for the next 20 years. If I pass away in that 20-year time frame, my beneficiary is going to get $500,000. You know, an easy example of that is, you know, I have a term policy with my spouse, and so if I pass away, he is going to get a lump sum tax-free payment. He will use that to pay down our mortgage so he can continue to live in our house. He will use that to help pay for things for our kids and maybe hire additional childcare help, okay? Because he no longer has my income, without this term policy, he might not be able to afford to live in the house and to continue to care for our children and pay for all their activities. So that is why we took out a term policy, and that's what a lot of young families do. Again, trying to cover that mortgage and some of those lifestyle expenses in the event one of the incomes in a partnership is lost. Other things that can deteriorate or just deplete our income is things like critical illness or disability. So if we become critically ill or disabled, we might not be able to work and we might be paying for added expenses. So a critical illness or disability policy is going to pay you out either a lump sum or a monthly cash flow that's really meant to help you keep the lights on, to keep the household running, and maybe pay for some additional treatments that might be necessary that you cannot afford because maybe you're not earning an income. Okay, so those are those types of insurance. As we get older and we've maybe started to build a little bit more wealth, sometimes one of the biggest problems is that we have all this wealth and we haven't maybe spent it and we want to leave it to someone, whether it's a charitable cause or it's a family member, but there's a lot of taxes. Okay, so one way we can protect against the taxes at the end of our life that would just completely deteriorate part of our estate, and CRA winds up getting a lot of our money. There is permanent insurance that you can get that will help cover your final estate tax bills. So if anyone's interested in that, certainly happy to have conversations about that. And like I mentioned, different types of insurance are really meant to cover you based on different phases and where you are in your life and where you are in your career. Okay, so finally, estate planning. Again, we've built up all this wealth. We've done all these great things in our life. How can we make sure that what we have is passed on to the next generation if we're not able to use it all? So estate planning really refers to planning your beneficiary designations and also planning for mental and physical incapacity. In other words, proper estate planning will make sure that you've assigned, who gets what when you pass away, but also who's going to be there to make decisions for you in the event that you are not able to make those decisions because you were physically or mentally ill and not able to make those decisions on your own behalf. Okay. So a lot of common mistakes, and again, we did do a whole 1-hour session on this, so I'm just going to touch on some of the mistakes. There's certainly more, and again, I'll make sure everyone sees a recording of that session. Some of the common estate planning mistakes we see is, having no plan. So there's no will, there's no power of attorney. You pass away and no one knows what they're getting, who's getting what. A lot of it goes to CRA and a lot of time is spent in court figuring it out. Okay, another mistake we see is incorrect beneficiaries. So maybe you've named a minor beneficiary where it does not make sense to do so, or you've named a child when maybe it would have made more sense for you to leave the money to your spouse and then have the surviving spouse ultimately leave it to the children. Okay, so just making sure that's all in order. A big one as well is inappropriate executor designation. So an executor is the person who's going to basically read the will and make sure everything that you said in the will actually happens. It is a big, big job. Make sure the person that you've assigned as your executor knows what they are doing or has some knowledge of that type of role, okay? And also, I would encourage you to make sure that your executor lives in Canada. Having an executor that lives outside of the country could have some negative tax implications to them, okay? Also, I recommend just make sure your executor knows, where your will is, who your lawyer is, maybe who you bank with, who your investments are with. That's going to save them a lot of time down the road. And, make sure your executor is really up for the job. Okay. So, and make sure your executor is still living, because we've seen a lot of wills where they were done 20 years ago and the executor has unfortunately passed away. Okay. So make sure that is, up to speed. And then finally, another mistake we see is inappropriate charitable giving strategies. So a lot of people may choose to leave a lot of their estate to a certain cause when they pass away because they like knowing that their money is going towards something that they cared a lot about. One mistake we see in this regard is that someone might say, okay, I'm going to leave 35% of my estate to a charitable organization. By assigning a percentage, that is open to a lot of interpretation. Okay, what is the estate? What is 35% of that number? What is that number? It's very confusing. Simply leave either an account or leave a designated dollar amount, because no one can argue, that's open to a lot less interpretation. Okay, So we have certainly covered a ton of topics today. We looked at an overview of a lot of different types of financial accounts. We drilled down a little bit more on some of the most common ones, which is RESPs, RRSPs, and TFSAs. We talked about different sources of retirement income, including a combination of your own personal savings and government benefits that might be available to you. And then we talked about, how do you protect the wealth that you've spent your whole life building up, or how do you protect the income that you're earning in the event something happens to you? And finally, how do we help with those wealth transfers? How do we make sure that it's your beneficiaries, not the CRA, that winds up getting most of your estate? Okay. So definitely a lot of topics covered here. Again, we have gone through 1-hour sessions on a lot of these topics in more detail. Today was a refresher on these topics. So at that, I will check the Q&A. It doesn't look like there's any questions right now, but certainly if anything comes up afterwards, or you think of something later and you have a question, certainly please let me know. And thank you everyone for joining today, and have a great rest of your day.